Joining us now is Dominic Armstrong, co-founder of Horatius Fund. Dominic, great to have you with us this morning. So the IMF warned that we are ignoring risks of a tightening in financial conditions, that we are complacent. I look at volatility in markets across the assets for you, in bonds, in FX and in equities. And I put it to you that we probably are a little bit laissez-faire in regards to potential black or grey swans. What do you reckon?
I think what is very clear from the report is we've got the relentless pull in one economic direction, and equally you've got quite an interesting political drag on what is going to have to happen cyclically. And markets are assuming, I think, that the politics will probably win that particular round in the first instance. But the background factors that are really interesting. I mean, a trade war is called a war for a very good reason. Wars are about destruction of value, and that is a relentless factor. The trickle down, the ripple effect of that is not. Obviously, the word China comes to mind, but everyone who makes a component of anything that ends up in a box made in China and exported is going to suffer from this. The other thing that I think, the one word that comes out in the report from the IMF is the danger of inequality. And that, I think, is being overlooked at our peril, because apart from anything else, inequality is the thing that's creating a very febrile environment, both politically and geopolitically, where, frankly, anything can happen.
Not being ignored by voters, it would seem, and it's influencing voting in certain parts of the world, for sure. Dominic, let me ask you, we're asking on our MLive question of the day whether Treasury yields are going to end this year above or below 3.25%. And the reason I'm interested particularly in this is I've got this chart which shows yields, US yields breaking through some key technical levels, and this chart goes all the way back to the 1980s, and therefore begs the question as to whether this is going to be just a cyclical uptick in yields because the endless march of technology generally has pulled yields lower, or is this something more structural we're seeing here?
I think that we are in new territory. This is definitely an area where, because of the shaking up of the world order and the risks that come with it, we are seeing that tightening. And I think the initial hope was that perhaps yields are being pushed up to create a cushion, so that at least there's something that can be given back come the next downturn. In fact, what we're seeing now is perhaps a revision of that. And of course, with the marching relentless strength of the US dollar, rising rates there, and a depletion of global US dollar liquidity, the ripple effect on that, in particularly emerging market debt, is worrying people on a scale that they haven't seen. And a new generation who've been looking at debt for 20 years haven't experienced quite this sort of turnaround. And therefore, I think it's very important not just to say, well, this is a storm, eventually it will pass, which of course it will, but this could be a slightly different weather pattern.
How bad could this storm become? Could it turn into, a hurricane? Could it turn into Greenspan? Could it turn into the bond markets in 1994, the early 2000s? How bad could it get, Dominic?
I think what's different, certainly when you go back to something like the Southeast Asian crisis of the late 90s, the difference is that the fundamental structure of emerging markets, their strong economic base, is very much more settled than it was then. We have a far greater strength and depth across many of the economies in emerging markets, so they're going to be far more resilient than before. I think when you look at this crisis, the question is, what is an acceptable return for what's there? If you look at across emerging market yields, we're picking up 7.5% coupon income from a broad emerging market portfolio. Is that an acceptable risk? Well, it may go lower. We might see a 9% return from that, but income of 7.5% in this environment, I think, is beginning to feel quite an attractive return.
We've talked about a lot of things to worry about then, but yes, it's important to think about the opportunities that might throw up then, Dominic, and you're very keen on, as you've referenced there, certain emerging market assets, emerging market credits.
I think that's right, because actually very often there's a sort of geopolitical sideswipe that has allowed a lot of prices to be marked down. It's that baby to bathwater ratio. As people have just unloaded emerging market debt, there's some very interesting and well-structured situations that are now providing a very attractive income.
On the corporate side, or
both corporate and sovereign side. I mean, even on the sovereign side, one's aware of terrific capital inflows into Africa, where a lot of African sovereigns that are well-structured economies are yielding 8-9%. As a result of this markdown, but actually are progressing strongly, and we're seeing GDP growth of equivalent levels in countries like Ethiopia or Ghana. And 9% coupon income can give you an awful lot of ammunition. You can take a lot of pain for that and still come out with your head above water. And when we see that whiplash effect, suddenly the slingshot of performance, you're still going to receive your 9% income, and you're going to see a little performance as well. I think we could be approaching some very interesting times as these valuations have anticipated most of the bad news. And the market knows this is happening and anticipates a lot of that.
Dominic, do you think, when you talk about opportunity and sort of having taken a bit of whiplash, I mean, the Brazilian market has been absolutely paced. The real is on the turn. The Ibovespa has had a little bit of a turn higher. And there are those people out there that are saying, look, if there is a constructive change in politics in Brazil, this would re-rate the market. Do you have any proclivity for Brazil at all as you look at EM?
I think that's absolutely correct. When you see as it were, a benign political environment that is looking towards a capitalist-friendly structure. I think we've seen Argentina receive very positive support from the IMF in their crisis. Brazil could see this turnaround, which would, I think, bring... People are looking for any excuse to be supportive of emerging markets. And when you see the, alas, all too rare opportunities of a very constructive political change like that, I think people are very open-minded about re-rating places like Brazil, yes.